Hey guys, it's Sasha. Last night, Google published their Q2 results and the results were not great. But the stock market decided that not great is actually kind of good in the current market environment and rewarded Google with a 7% increase in their share price this morning. In this video, I will go through those results and explain what Google did well and where the results really did not look particularly good. And then I will share my updated valuation model for Google and my revised target price. My target price has dropped this quarter, and I'm baking in many more conservative assumptions within the model, and this is probably going to be the case across the board for me with inflation where it is and the threat of a recession looming. But just before we dive into all of the numbers and the details, remember, I am not a financial advisor and I'm not your financial advisor. I'm just a random guy on YouTube sharing my personal analysis, my opinion on what I'm doing. So please take it for what it is. And remember that I am also a Google shareholder, so I may well be biased in my assessment. Alright, so Google posted a new record of $69.69 billion worth of revenue in Q2 2022, and this is 13% up year on year. Now, 13% is pretty low for Google, and I'm going to explain exactly what's going on in here for a second. But you can already see the effect of the strong dollar that is causing this revenue to be 3% lower than it would otherwise be. And because of the various headwinds, Google's operating margin was only 28%, which meant net income dropped from $18.5 billion in the same quarter last year to just $16 billion. The good news is that Google is buying back shares at a very healthy rate. You can see that Google's cash and cash equivalents dropped by $15 billion this quarter, and some of that could be potentially attributed to the strong US dollar, but you can also see in the cash flow statement that Google bought back a record $15.2 billion worth of shares. That is a lot. This quarter, that's almost the same amount as the net income for the business, and given the Google shares sold off like everybody else, the buyback, the effect of this buyback this quarter is going to be particularly good because they're going to be buying considerably more shares as a number of shares, and that's going to improve shareholder value. But looking at Google's individual business lines, growth has really slowed down. I've taken these numbers and stuck them into my model in the Excel spreadsheet, and you can see what's happening here on the right. This is the annual growth as a percentage on those numbers. You can see that this latest quarter is a lot softer than what we've been used to seeing recently. Google's main business, which is ads on Google search, only grew 13.5% compared to 24% last quarter, 36% the quarter before that, and 44% the quarter before that, and so on, and everything else was also pretty low. YouTube's revenue grew by just 4.8%. You might have heard some of the big finance channels on YouTube moaning and complaining that they're earning less than they used to. Diddums. The only solid growing business for Google is Google Cloud, which grew 35% year on year, but that is still lower than the roughly 45% year-on-year growth that we saw beforehand. And it's important to remember that Google Cloud is still a loss-making business for Google. Google is losing money on that business line. There was a question on this in the earnings call, but Google navigated it very accurately and politically, saying that they think Google Cloud is going to become strongly profitable with more scale. It's probably the case because this is still so early, but slow growth this quarter is not necessarily a particularly bad thing, and here is why. You can see that Google took a big hit in 2020 when COVID first arrived. There were 3 consecutive quarters where the growth numbers just got decimated. Businesses were locked down, companies were shut down, nobody was spending money on advertising, the travel industry got destroyed. And when we look at the same numbers the following year, this yellow section, you can see that the growth last year was absolutely massive. And this is because those quarters in the yellow were being compared to these red quarters when the numbers collapsed. So yeah, it's easy to have grown at 70% or whatever it is when you were 22% down the year before. This is another example of the bullwhip effect or the ripple effect, call it whatever you want, because last year in 2021 we had this market euphoria. Lockdowns were on the way out in the summer and we had this overcompensation compared to what happened in 2020. You have this big down in 2020, like when you get the first ripple coming through and then you coming back up, and you have a massive up year in 2021, and now we're in 2022 and we're seeing the next down wave coming. Q1 last year was up 35%, and so when we're lapping that quarter this year, Q1 dropped to just 22% growth year on year. And then Q2 last year was a whopping 62% year on year growth compared to the year before that. So this year, the rate of growth has slowed even further to just 12%. But just like the ripples that go up and down over time, the long-term trajectory is still extremely consistent. I did a quick calculation here, and the different quarters are all growing very consistently at an average rate of about 24% year on year. By the way, I share all of these models with my team members in the Patreon, and I share the target prices with everybody, and we talk about the stock market, companies, valuations, all of that stuff every single day in the Discord. So feel free to join my Patreon if you want to get access to that Discord. If you want to get access to special member videos, I post them about every week. If you want up-to-date target prices as and when I update them rather than as and when I go and make a YouTube video about it, and a whole lot more, the link is in the description. So over time, if we don't have other issues happening, these wobbles up and down will generally flatten out, and I'm going to be expecting a considerably more consistent next year and the years beyond that if we don't get something really big thrown at us again, especially when we're coming back down from the inflation spike. So I've revised down my assumptions for growth for Google. I'm actually keeping them considerably below where I think they will end up, to be somewhat on the conservative side, certainly below where the data is indicating. So I said, let's assume Google search ends the year on an average of 18% growth year on year. Remember, significantly below that 24%-ish mark where it was before. So far, it's been 24% and 14% in the first two quarters, and Q4 numbers should probably bring that average up to the 80% mark. And then, instead of raising it back up, I'm going to go and just decline that rate of growth every year all the way through to 2027. Then I'm projecting a pretty low year for YouTube, but I'm also expecting YouTube to then come back next year to a 20% growth rate, still far below where it was before, and then it will reduce there in the model from there. I still think this could be a somewhat conservative assumption. For me, YouTube is still in the early stages of growth, and so again, I think that this might be on the conservative side. And the other important number in here is Google Cloud. I set it to grow at 42% this year, and that rate then gradually slows down. Given that it's still so early for that business, this is, again, I think probably reasonable, maybe not as conservative as some of the others, but I would say somewhat reasonable as an assumption. Then we have the costs. You can see these numbers have been trending steadily, and I'm assuming that the cost of revenues for Google stays at 44%, has been at roughly that figure very consistently in the past, and then I'm expecting that the operating costs will continue gradually coming down over time as a proportion of revenue. I haven't actually changed these assumptions this quarter, and they haven't really been moving at all recently. You can see that my projection for this year is almost bang on what we just saw in Q2, so all of that looks on track so far. So on the left here, I just take all of these assumptions in terms of growth, multiply them through to get my EBITDA numbers, and then here is the calculator tab. I'm using the same 10% discount rate in here. I know some people might say that because inflation is running hot, maybe you should be using 12% or even 15% for the next year or two at least. I don't know. But this year, we're still sitting at below 10% on inflation, so the cost of opportunity is still the limiting factor, not inflation, in my discounting. And will inflation go up to above 10% somewhere towards the back end of this year or next year? Very possibly. I really don't know, but if it peaks towards the end of this year or early next year, it might then dip back down by the end of next year. So I don't think 10% is all that crazy. Anyway, I've excluded the 2 quarters of this year from this year's numbers, not that it really makes any meaningful difference. So that's why those numbers from this year are looking a bit funny. Then I have set the long-term growth rate at 4.5% and the EBITDA multiple in 2027 to 15 times. Both of those to me seem quite reasonable for this kind of company in this kind of position. As we've just had the 20-to-1 Google stock split, we now have 13 billion shares outstanding. And when we do all of the maths, I get a target price of $149 using the perpetuity approach and $196 using the EBITDA multiple. Will a 15 times multiple be appropriate in 2027 for Google? That, a company that is still growing relatively fast at that point and has very, very solid margins? I'd say sure, why not? So I will go somewhere in the middle of those two and set my target price to $180, which is a drop on the $200 that it was beforehand. My main reason for this drop is because I adjusted all of my growth assumptions down a fair bit this quarter because I wanted to be a bit more conservative. That adds a bit more of a cushion if numbers go back up, but to me it feels somewhat appropriate given what we're seeing in the economy. At the moment, Google is trading at about $112, so the ridiculous situation is that this still represents a 61% upside for me. Oh, and your upside can be even bigger if you use one of my links in the description to get yourself a free share or some kind of bonus cash for signing up for one of my favorite investing apps. Those apps are also super cheap, so you get to save on the fees as well. If you're on one of the old expensive platforms that charges you $12 or £12 per trade or whatever it is, that is a huge amount of money to be throwing away, so be sure to check out some of my favorite cheap investing apps using the affiliate links below. Now, Google is not unique for having a big upside at the moment. Because of the market crash that we've been seeing at the beginning of this year, and for growth stocks it started really in November, many of the upsides out there at the moment will look absolutely bonkers, and this is why I am continuing to slowly buy Google shares as well as many other companies that we're going to be talking about later on in this earnings season. Google is one of my big positions in my own portfolio. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching. I really appreciate it. And as always, I'll see you guys later.